In short, value investing is the idea of buying cheap stocks. That is, finding stocks whose market price is low in comparison to its fundamental value. So while value investing appears in some instances to be logical, before we engage in this particular investment strategy, it's important to identify the philosophy behind value investing. That is, what is the explanation as to why value stocks might outperform, and what views of markets does it tend to accord with? Well, value investing has been around for a very long time because it really accords with the old market adage of trying to buy stocks that are underpriced. What differs across a range of different value strategies is the question of how you can actually measure fundamental value. This is an issue because while we can observe firm price, the market value, fundamental value is unobservable. So the key driver or the key explanation for value investing is the argument that there are systematic behavioural biases that affect the way that we actually, as investors, measure the fundamental value of the firm, which can result in this mispricing. In particular, the key behavioural bias that tends to be identified is the idea of overreaction. And what we look at, the idea is that investors tend to overreact to growth prospects in a firm. And because they overreact to growth prospects, those firms that have significant growth opportunities tend to be overpriced, whereas the boring firms that maybe don't have such large growth prospects or growth opportunities, they tend to be underpriced because the market doesn't pay as much attention to them relative to the growth stocks. Now, when we're actually coming up with identifying a value firm and trying to come up with measures of fundamental value, there's a range of different ways that investors might seek to identify value. That is, they might be looking for stocks which current market price trades at a discount to maybe either the accounting book value or the tangible book value of a firm. They might look at stocks that have high dividend yields as a way of saying that the market price is quite low because the cash paid out by the firm is a higher ratio of that market price. Or they might look at things like low price earnings multiples or low price to book multiples. Now, it should be noted that value and growth investing are often considered to be opposite ends of the spectrum. Growth investing involves investing in companies that exhibit clear signs of above average growth, even if the share price appears to be expensive in terms of metrics. That is, growth investing is about identifying companies that you think are going to do well in the future, whereas value investing is trying to find the cheap stocks, the neglected stocks that might be underpriced. Now, if we look at the body of academic evidence as a whole, there is pretty strong case to suggest that value tends to outperform growth as an investment strategy over long time horizons. Now, I mentioned before that the value investment strategy is not a new idea. It's been around for many years. And in fact, we can look at a statement here by Ben Graham in The Intelligent Investors back in 1973, where he identifies this idea of value investing and, without explicitly noting the issue of behavioural finance, actually lays out the investment philosophy that accords with this, that's aligned with what we discussed earlier around investor overreaction. So he says the speculative public is incongruable. It will buy anything at any price if there seems to be some action in progress. It will fall for any company identified with franchising, computers, electronics, science, technology, or what have you when the particular fashion is raging. Our readers, sensible investors all, are of course above such foolishness. So you can see here the point from Ben Graham is that he believes that investors overreact to companies where there's some action or where there's some obvious growth. And that overreaction will cause those firms to be overpriced, such that investors probably shouldn't be investing in those particular companies, but should be finding the cheap value firms that maybe are a little bit more boring and a little bit less interesting, but as an investor can result in higher returns. Now, the reason that Ben Graham might be particularly relevant and particularly important here is because Ben Graham was actually an academic, and he had a student in this class by the name of Warren Buffett, who took on a lot of his principles. And Warren Buffett has gone on to be one of the most widely known value investors through time. Since Warren Buffett, we then have had the emergence of academics who have identified and studied this area of value investing, and the most famous of which are Eugene Farmer and Ken French. Farmer and French have identified that value outperforms growth across a lot of different markets and asset classes, and their work has brought value investing into the mainstream. But what I think is a really neat quote that really summarises Ben Graham's view and really summarises the philosophy behind value investing is the statement we see on the screen now. The idea that obvious prospects for physical growth in a business do not translate into obvious profits for investors. So to take a step backwards, what do we know is that if in a perfectly efficient market we had two companies, one that had huge growth prospects and one that had very limited growth prospects, in an efficient market, the information the market already knows about those growth prospects, or the publicly available information, should be embedded in the price, such that you'll just find that the company with high growth prospects would have a higher price, and after controlling for risk, the subsequent returns of both those firms should be the same. But what Ben Graham's arguing is that in fact markets are not efficient. Hence, we've got that firm that's got the higher growth prospect, it's got the higher market price as implied by the publicly available information. But because investors then overreact to the information, they increase the demand for those particular shares and hence bid up the share price even further, such that the subsequent returns of these stocks with obvious growth prospects actually tend to be lower. And on the other side of the coin, those stocks that are less glamorous, with less obvious growth prospects, these neglected stocks tend to be cheaper, and there may be some merit in trying to identify those underpriced stocks, and you can earn abnormal subsequent returns for doing so. So, given this philosophy of value investing, the question then becomes, if you were to create an investment strategy based on this idea of value investing, how would you go about doing it? Well, there are three main approaches to value investing. The first is passive screening, and this follows in the tradition of Ben Graham, is where you identify screens, or you identify firm characteristics or financial data that can be used to look at this ratio between the fundamental value of the stock and the market price. And basically what you do is once you're able to come up with this measure of price versus value, you'll buy those stocks that have a relatively low price compared with your measure of their firm value or firm fundamentals, and you'll sell those stocks that have a high price relative to fundamental value. The second approach is contrarian investors. Contrarian investors are the view that companies that have done well recently, those stocks might be overpriced because of this overconfidence that we spoke about earlier, and hence they should be sold. So contrarian investors in some ways can be seen as the opposite of momentum investing that we've looked at previously, but the two are actually not necessarily inconsistent with each other because contrarian investing looks over a long period. So previously with momentum, we saw that momentum is an intermediate term phenomena. You buy stocks that have done well over, say, the last year, and you hold that portfolio for 12 months and then rebalance. Contrarian investing looks over the long term. It's buying stocks that have done poorly over the past period of time, but then potentially holding those stocks for a period of 5 years. And what we actually saw when we looked at the evidence of momentum in the previous lecture is that whilst past winners do tend to overperform over the subsequent 12 months, there is then mean reversion over the next 4 years or so. And it's that mean reversion that contrarian investors are trying to pick up. Therefore, one could actually argue that not only are momentum and contrarian investing not inconsistent, they're actually perfectly compatible with each other because of the different time frames used, the longer time period of investment used by contrarian investors. The last form of value investing is activist value investing. An activist value investor is an investor who will identify that there is a company whereby there is a value gap. That value gap is the difference between the current value of the firm and what the firm could be worth if it was run and operated at its full capacity or full efficiency. So they'll come in, often engage in a hostile takeover, and make changes to the business itself. So the activist, in a sense, they will take control of the business and make changes and then seek to profit from the changes that have been made through improving the efficiency of the firm and hence improving its value and its market price.